this time we switched to a new platform because this episode will have a very high number of registrants. I believe you guys are all waiting for and look forward to this discussion with the 4 speakers in our panel today. My name is Anne, and I'll be your coordinator. Before we actually start the discussion, I just want to go through some housekeeping. So first, this is a recorded session. If your time zone doesn't allow you to join, then we'll send you the recording. And the structure of the workshop stay the same. We will start with some questions that you send to us in advance. And then in the other half of the workshop, we'll have direct discussion between some of you with the speakers. So if you could now send in your question to the Q&A box, our guest speaker can see your questions, and then they later can ask you to open up the question and share about your question directly with them. So we hope that this will be a very interactive discussion. Right, so without further ado, I would like to introduce our speaker for the discussion today. We are very honored and we are very lucky to have our 4 fantastic speakers. And each of them will bring a different lens into the topic, what investors are really looking for in a startup. And first, we have Mark Gilligan, the CEO of Black Sheep Power. Mark, could you help to turn on your microphone and introduce about yourself?
Yeah, so I'm Mark Gilligan. I have been a founder and CEO of a variety of companies in the life science tools space and microfluidic player. I've raised funding from all kinds of investors, ranging from corporates to private equity to angels to everything in between. But I also have gone through the full cycle to exit from my business and then become an investor myself who pulls consortia together to acquire and invest in businesses. So nowadays I spend my time probably much more on the investment side than anything else.
Thank you, Mark. And next we have Alex. Alex, could you also unmute and introduce about yourself?
Absolutely. Hi, my name is Alex Slack. I am one of the co-founding partners of Luxera, which is a San Francisco and Paris-based growth and growth buyout investor across different health tech verticals. My background is as a pure investor at 2 previous funds, including Maverick Capital, where I've seen the continuum of investing in different health tech companies, including a strong specialization in life science tools, from everywhere from the sort of late VC stage all the way to public listings. And then in my current firm, which manages about 600 million of AUM, we primarily do growth and majority deals for companies that are a little bit more mature in the sort of 10+ million range. So really excited to do the panel today, and I think we have a great group here to provide a mixed set of perspectives.
Thank you so much, Alex. And Austin, thank you for joining us.
Yeah, it's great to be here. So Austin Duke, Managing Director with Broad Oak. So Broad Oak has been investing exclusively in life science research tools and pharma services for the last 15 or so years. We do that from end to end. So founding sponsors of an accelerator in the space. We have a venture capital fund, a growth capital fund, a later stage income fund providing debt for more mature companies. And then we also have M&A advisory. So for tools in this sort of infrastructure space for pharma and biotech, commercial stage businesses, that's where we focus. Similar to Alex, have roughly 600 million under management. By way of background, I've spent my career investing and operating in healthcare and life sciences businesses. So I was or am a type 1 diabetic. I benefited a bunch from innovation in this space and wanted to pay it back or pay it forward. So after graduate school, helped start a medical device company and helped lead that for a number of years, and then switched to investing. So first leading an early stage venture capital fund that was investing broadly across healthcare, so health IT, digital health, tech-enabled services, devices, et cetera. And then now focused on commercial tools and services businesses here at Broad Oak.
Here. Thank you so much. And we are very, very honored to have you joining us, because I think this is one of a quite rare occasion where we have the group of audience and also speaker who focus like specifically in the life science tools, especially application of microfluidic system. We have another speaker, but he will be joining us a little bit late. So I think we can just start with
I'm here.
I think he's on. Yeah.
Oh, Jason's
Hi,
there.
I'm
Oh,
here.
Jason is here.
Yes.
Hi,
Hi, everyone.
Jason.
Hi.
I'm sorry I didn't see you.
Oh, no, that's quite all right. I had to make a quick sprint. So great to be here, everyone. I guess I'll do a quick introduction. So Jason Melled, I am formerly the CEO and managing partner of Start Codon, which is an early stage life science accelerator in the UK, investing in life science companies from across England, Scotland, and Wales. And before that, I was the CEO of Cambridge Epigenetics, now Biomodal, a research tools company developing assays for epigenetic biomarker discovery. And I've just recently moved into my new hat, which is running a company called Autoimmune that I've co-founded with my Start Codon co-founder, Dan, focused on the earlier detection and better stratification of care for autoimmune disorders.
Very impressive. Thank you, Jason.
And I think the reason why Jason has a slightly different perspective, because Jason really has been investing in pure startup at the very, very, very beginning, which is again different to Austin and Alex. So I think probably, I don't know, Austin, I think maybe you've invested a little bit in the really early stage at some points in time as well, but I don't think, Alex, you have you? Yeah.
I've done,
We've been
I've done a
Series
little
A and
bit,
later.
but
Yeah.
yeah, I've done a little bit, but we try and focus on commercial stage. So in previous background, have done a lot of pre-revenue or very early ideas, but I'd say today we skew more towards commercial businesses.
And I think that's the first learning point for the people attending, is that there are a lot of different investors with very, very different definition of their own role in the whole investment world, ranging and from really early stage to really late stage. The money tends to get bigger as you go later stage, and the risk profile tends to reduce as you get later stage in general principle. So just out of interest, Jason, in terms of what you were investing in Start Codon, what was the quantum of how much you thought was a reasonable size investment?
So we had a standard of writing checks between 250,000 to 500,000. It was only very rarely that we would write a larger check of 500 up front. So the standard was 250,000 as the initial check, pre-seed companies that we were building from scratch.
Yeah. And Austin, what's the sort of value range that you've historically worked in?
Broad Oak, I would say on our early stage funds, across everything we do, we say we don't have a minimum. So if it's a great company, we want to find a way to get involved. But on the maximum size for our early stage funds, it's probably $1 million or a little bit more on initial investment, going up to 2 to 2.5 over time. On our larger funds, checks usually range from 5 to 10 million.
Yeah. And Alex, your kind of price point range or investment range, where's that?
Yeah, so previous life at Maverick, we would do 5 to 25 million checks in sort of Series A, but more likely Series B and later companies, particularly in tools. And then in my current firm, we're writing between 20 and 45 million checks, and those are typically for sort of companies that are doing at least sort of 5 to 10 million of revenue in the rear view, and funding then real scale up. So you can see, the check's bigger to fund. A sort of greater ambition from a revenue side there.
But I think also the other thing is that probably each of what you're looking for in a deal will be quite different. So Jason, I'm assuming if you're investing at the very early stage, you'd be looking at the inventiveness of the IP and what the key clever thing was, the clever idea. Is that true? Or what would be your key thing you're looking for at the beginning?
Well, honestly, in the very beginning, we're looking at the team more than anything, because we reckon that so many of the companies we invest in at pre-seed stage, the original tech or idea is probably rubbish. But if the team is really clever, they know their space, they have a really deep understanding of the unmet need, we're confident that they'll pivot multiple times, but they'll get it right. So first and foremost is the team, and then shoring up that team with outside expertise. And then we look at the tech and solution they're developing. But we assume that they have a hypothesis, but they haven't gotten it anywhere near product market fit yet.
Okay. Yeah. Okay. Fine. That's it. Yeah. Okay. Good. And Austin, from your point of view, I mean, I guess everybody's going to be focused on teams to some extent. So, Austin, what would you say?
Well, it's interesting. I agree with everything Jason said, especially at that stage. But I think we've seen, if you bucket into team, product, and market, we see the emphasis on each kind of change over time. So we looked back from our growth capital investments and kind of said what was most important at the time of investment. Was it the team, the product, or the market? And it actually ended up being the team was least important. It was more about the product and the market. And that's not to say teams are not important. I think they matter more earlier, where you're trying to navigate into the tailwinds of a market and product market fit, and you're trying to make sure you're solving the right problems, and having that agile, very capable, very determined team matters most. As you start to see a growing, scaling business, team is still important, but the ability to become a much larger business may have more to do with the market that you're in and that technology. So for me, overseeing our early stage fund primarily, it's a bit of a mix. I prioritize the team and the market above the product. So if it's an attractive, growing market and a smart, capable team, I trust that they'll figure that out. That's not to say we don't ignore the technology. We don't take fundamental technical or product risks. We really want to take that product market fit risk. And so we're looking for big markets and teams that can navigate that.
And Alex, at your sort of slightly later stage scale, what do you think you're focused on?
Yeah, so we try not to take product market fit risk, and we take scale up risk. So it's great. We have this great continuum, I think, among the three panelists here. So it's fantastic. I think what we would typically do is we would diligence over a reasonably significant period of time, customer experience, the cost to serve a customer, the unit economics of a customer relationship, everywhere from getting that lead in the front door to closing a deal to then serving the customer and continuing to, hopefully have a recurring economic relationship with that customer. And the scalability of that kind of unit economics, how much does it cost to acquire and serve a customer versus how much gross profit can you generate from that customer? That then creates a case for growth capital. Because if you invest the left side of that equation up front and continue to get or expand the same of the right side that you expect, that's where you can have a very productive investment.
Sorry, so I distracted things away, Anne, from what your questions were. So maybe we can go back to you being the one leading things.
Thank you, Mark. You start with the first question that I would ask all the speakers. Yeah, my to follow up on that, the next question is something that really resonate with the microfluidic space. So we have many companies that are building like product or services, but they are still either in development or trying to find the product market fit. So I think that's the main audience we have today, because that process, it will take a while. So for you as investor, how do you track that progress in this situation, and what should founder be doing to keep the investor engaged and confident along the way? Would you want to open up this, Jason?
Sure, I'll go first. I think that two things, well, actually three things come to mind at a high level. Number one is I always like to raise 2 rounds in advance. So for example, if I am a company, or that's a company I'm investing in pre-seed, I want to make sure they're engaging with seed and Series A investors to kind of work backwards as to what KPIs and what proof points they'll have to hit, which milestones are key to unlock that capital. Same thing goes with partners as well. If you're saying that you're going to be doing partnership deals, everybody can say that, but have you spoken to your partners? Do you have a clear understanding of what they want you to demonstrate in terms of functionality, market traction, etc., in order to secure that partnership, in order to secure those later rounds? And then we can say, right, how far can my 250K get you on that continuum? And who else is going to come in to help bridge that gap? Is it non-dilutive funding? Is it other investors? Is it other sources of revenue, perhaps? Because if you don't know where you're trying to get to, you can't work backwards to figure out what you have to achieve to hit that key inflection point. So that's number one. Number two, I would say, is engage early and often, because as investors in the early doors, we're here to help. We call ourselves adventure builders, StarCodon, because we want to get into the weeds and the nitty gritty. That's very different from when you're maybe growth in later stages, the other panelists can speak to. But at our phase, half of the people we invested in, a little over half, were academics who had never done a startup before. They were obsessed with their tech to the point where it became dangerous in many cases and harmful, because we said, just because you have a hammer, not everything is a nail. You need to be obsessed with the problem and developing the right solution. rather than just a cool piece of tech that you published in Nature. And so if you engage early and often with your investors, we can work with you to figure it out as a team rather than saying, go figure it out and come back to me when you've de-risked. And the third real quick one I would say is keep an eye on failing fast. Everybody talks about failing fast, but what does that actually mean? It means you need to find the quickest way to pressure test your idea with the market. And if it's not a good idea, you modify, you pivot, or you drop it as soon as possible. And I think too often people say, I'm going to build this Ferrari because I know what my people need. But maybe nobody wants it. Maybe they want a Ford Pinto or like a Honda Civic. Like focus on the MVP, get it out, get the feedback, and then go. I'll stop there.
I think
So
it's
maybe I
all
can-
one question.
Maybe I can
Austin?
pick it up just along the continuum here. So usually we're saying the product is quote unquote done, which is not a great descriptor, but once you can start to sell it, right? So oftentimes we've had, and I imagine the other panelists have been burned by, hey, a product's going to launch in 6 months and 18 months later it still hasn't launched. And so for us, if you can exchange that product for $1 or whatever of revenue, then it's done enough that we can start to test the product market fit. Now, whether that's completed product, MVP, or what have you, is not germane to conversation today. But my point is, once we have a product out there, now we're searching for product market fit. And that's a very ethereal concept that's very hard to define in one metric. It depends on the product, on the business, on the market, et cetera. But some of the sort of anecdotal things we're looking for or interested in, especially in the early stage, is like, why does this big pharma or biopharma company buy from this little startup that nobody's ever heard of? Right? It's one data point, but what is it that brought them to you? So I'm always asking founders, how did you meet that company? Did you go out and did you meet them at a conference, or did they find your website? A company we invested in recently had a landing page and a paper, and that was all that was on there. And they started getting inbounds from big companies. Like, that's an interesting signal that whatever they've done resonates. So those anecdotes are interesting. There's this feel of market push versus market pull. So market push, you're out there banging on doors, the sales cycles are long, you're getting told no a lot. And that's part of that navigating to the right customer who needs your problem or your product today. The market pull is when those sales cycles start to come in, your sales efficiency really goes up, right? Your dollar invested in sales and marketing is generating more and more in terms of revenue and the subsequent periods. Those are the types of things I think jump out pretty early on for us in terms of product market fit. But when you've got de minimis revenue, it's really the anecdotes, right? So being able to tell your story about your relationship with your customers and the people that are looking to purchase from you, I think can do a lot early on to give a sense of how well you understand your market, how well you understand your customers, and why people are excited about what you've made.
Yeah, those were both fantastic comments, and I completely agree. I don't have much to add. I would just say, I mean, to Austin's point first, like and to Jason's point as well, you have to set, what is the definition of success when, revenue in many cases cannot be the definition of success, because you're an earlier stage company. A definition that we found to be materially predictive is the velocity of the growth of a customer relationship and the collapsing of those sales cycles rapidly. So if you can, if you can show only in a few customers that you make very rapid progress, across whatever relationship milestones you can set up, that has been highly predictive. And then just one other comment that I'd have as well is also just beware the pilot relationship, because that is an area where I see earlier stage companies also that come to me as well, really getting stuck, is offering sort of semi-paid or even free, in worst case, pilots that also don't have clear milestones to force companies to purchase the product. And in many cases, you are setting yourself up for failure in these pilot relationships, because they learn so much about your box, they learn everything wrong with it, and then they don't end up being purchasers. Whereas if they've already put their money on the table, they at least have something invested in your success because they've put their reputation on the line as well. So that would just be another point I'd talk about.
I want to follow up on Alex's point because it is so true, which is the companies that or the investments I've made that I got most right were based on essentially one early customer and rapid growth within that. And the other side of that coin is a lot of times you can get penalized from the perspective of an investor that you have customer concentration. And understanding the difference there is pretty important, right? You've got one customer and maybe it's a pilot or maybe it's one big contract that's interesting and the actual top line revenue number looks compelling. But the growth rate in a customer is where it gets really interesting. And then your ability to not only know, but to convey that this customer is one of potentially many, not one of only, meaning you haven't built something just for them that they rapidly adopt. But if I, as the investor, can see this scaling, across an organization or a purchase behavior growing month over month, and I can see where that's going to translate to the next one. Like when I've been able to do that, those have been my best investments, even if it was in one customer to start with.
I think the other thing is also to try and explain what that means for some of the audience members. So I could give an example, I think, which is talking about the sort of thing you're talking about, which is where we historically might have sold a product to one specific site of a multinational pharma corporation. They then told their friends in some other site somewhere, another department, and then maybe to start with, another department in the same site buys one, but then another site in the same country buys one, but then you start getting other countries buying it as well, until you have like 12 systems around the world in different sites all over the place, and that all took place over 6 months, and each of them is like $150,000. Well, that's quite explosively successful for a small startup. And the main thing there is that usually, if you look back at the actual story, there was a champion somewhere inside that company who was just very, very enthusiastic, and they kind of became the internal salesperson for you. So if you can find those internal salespeople, that's really, really, really good. But sometimes you don't manage to get it. So within another corporation, you don't happen to quite get that. So you still sell into them, but it's not quite as effective because you don't have that internal salesperson. So that it's finding those people is like gold dust when you can get somebody who really buys into your technology product and really wants to help their friends around the organization use it.
Yeah.
Sorry, Jason's got his hand up there.
Yeah, Mark, I just wanted to come in on that because I think it's an excellent point. This is why it's so important to engage. It's what we tell our early stage companies all the time. Engage, but don't go pitching. Not until you really understand the unmet needs and the wants. Because if somebody needs something, everybody focuses so much on, I know what their needs are and I really understand it. But do they want to pay for it? Do they want to pay for it more than once? You really have to delve in, go in listening mode. I always say, first conversation, 80-20, 80% listening mode, 20% talking. Then you come back again and say, I think this is what you want and need. Am I right? And then the third time you come back, you're in pitching mode, 80-20, where you're like, hey, I've developed a solution for you. I know exactly what it is you want, and I understand your pain points and what your billing cycles and your adoption curve looks like. I think also the cardinal mistake I see for early stage companies is putting logos in their deck because they had one pilot project or they had one conversation with somebody and suddenly they're the strategic partner to end all. You go, is that a real deal? Is that really going to be lucrative? Like, yeah. We did a free pilot, to Alex's point, with them, and they said it's going to turn into revenue. Saying, no, it's not. Investors know this. We can see it. Please don't think that we'll be fooled. And be sure that if you are doing a pilot with somebody, before you get started, it's worth your time because it could be a distraction. It may seem nice that you're getting a bit of cash, like 50 or 100K, but if it's not leading to something greater and it's distracting you from a more lucrative and productive relationship, feel free to say no. Too often people think, I have to show something. And so they find somebody in a large corporate who has a bit of budget left at the end of the year, and they're happy to sign off a one-off pilot program for 50K, and you'll never see them again. And you think that's success, but it's not. So be very careful what deals you make early on. It's not quantity, it's quality.
I think another part which is worthwhile bringing to the fore there is, in my experience, when you've got one of those customers that's been very successful on multiple sites, there tends to be a really good relationship between somebody in the startup or in the investee company and that key internal salesperson. And it's not about sending some emails, and it's not about having a couple of conference calls. It's actually being together with that person, having lunch with them sometimes, having dinner with them sometimes. It's not fake dinner. It's actually truly building a proper human relationship with that person where they truly buy into what you're doing. And I think that business development isn't about sending some emails out. It's about actually being with people in real life and really building that relationship when you can see there's that fit between the technology and their problem, and that they see that too, and that can make that strong. So yeah, from an investor's point of view, when I see that they've got a company has got a really good specific relationship with specific key individuals, that makes me feel warm and fuzzy.
Yeah,
That's absolutely right. Yeah, and I think you just have to, but a person who's not willing to pay, close to full boat for a pilot at a minimum, if not just buy the machine, he or she is probably not worth your time either. And that's a great litmus test to manage your time as a busy startup founder.
And just to put in perspective, that I've seen companies sending machines for free to the customer to try, and the customer doesn't get out of the box.
Yeah.
And they just leave it there. So it's costing the company lots of money and effort to get that box there, and the customer doesn't really give a monkeys about it because they're not invested any of their financial resources into it. Whereas if you make them pay a lot of money for having a go, then they really care. Actually, the thing which actually I think I saw, which was the most extreme situation of this, where somebody didn't have enough money to buy something, so we rented them a system, which was at about 10% of the purchase price. But we also said that, if they gave it back, then they didn't get the money back. But if they bought the real machine, they got some percentage of the amount of accumulated rental off the price. But what happened was they got it and they felt this urgent pressure to use it immediately because they saw they were paying rent for it. So they had to use it immediately. So if you sell somebody a piece of capital equipment, sometimes because they have bought it, but actually there's no kind of great urgency, they might not take it out of the box for the first month or two. But actually when they're renting it, they realize the clock's ticking immediately. So they started then using it like literally day one. They start using consumables. And because they're aware that after the first month, they've got to give it back unless they pay another month's rent, then they kind of really keep working hard on it until they ended up renewing the rental for about 6 months, to the point they realized they'd actually already paid for more than half the product if they just bought it in the first place. And they started stressing slightly, oh my God, we should just buy this. Instead, it'll be cheaper. But they already ended up paying more than the cost of buying it in the first place. But they also got going much earlier with their work because they were renting it and they knew it was a limited time period. So the way you structure that relationship around the financial side really makes a big difference to how effectively that relationship builds. Of course, having a product that actually is useful to the customer is rather critical to start with, though. There are plenty of products in science that are interesting scientifically, but not actually that useful to somebody's core problems, which is a slightly different problem.
I just wanted to give a quick cautionary tale and an anecdote exactly in this vein. So at Cambridge Epigenetics in the early days, we made some critical mistakes with key opinion leaders. And everybody assumes in a startup, it's like, oh, find that KOL. It'd be the KOL company or KOL individual, big name professor, big name person in biotech, whoever it may be is your potential customer. And you'll go to them and they'll say, well, I'm a big deal, right? So you're going to give me what you have for free. And the shine of me using it will be worth its weight in gold. And so I made the mistake of too often in the early days giving these big name academic KOLs, in our case, a free kit because they were going to get that Nature paper. And that Nature paper was so worth it. And that kit sat on the shelf for a year and a half. They did nothing with it because they didn't value it. And by the time they did get the paper out, it was about 3.5 years after that. So it served no purpose whatsoever. But some people, you have to be very cautious of this, will try to convince you, especially if you're an early stage startup, you're feeling desperate for external validation. They'll say, well, I'm so important. You should be grateful that I'm even considering using your product. So give it to me for free. And then by the mere fact I'll give you a testimonial or some publication, you will bask in my glory. And I say run for the hills if somebody talks to you like that, because they don't value you now and they won't value you ever. And there's no point even going down that path.
On that front, actually, Jason, the academics who we partnered with that were the most effective for us were the early to middle year academics who really wanted to go somewhere because they had a lot to prove about themselves as well. And if they could see that by partnering with us, they didn't have enough money to buy our stuff, but if they partnered with us, they could actually do stuff that would actually allow them to validate and prove to the world that they were amazing. There was one Brazilian professor we actually partnered with because he was really smart. He didn't have enough money to buy our stuff, but we could tell he really, really was going to work hard. And we ended up, because we wanted him to go and talk about our products around the world, we ended up promoting him to conference organizers all over the world. And he became well known in a field that he would not have been able to do himself, from Rio de Janeiro in a provincial university. And he became famous because he worked with, but also he generated a load of business from our point of view, because he actually really pioneered a variety of scientific fields. So that's the other side, which is that the people aren't famous yet, but you can help get famous. You've got something to win from both sides there. Sorry, Anne, we might have gone off for too long in that topic. I don't know if there's some more questions you want us to focus on.
No, I really appreciate all the sharing because that's from the investor's view, that you are not just looking at the product, but also like the velocity of the team building relationships with customers. But actually, I have another question. How about some more technical, like cold cut metrics, like burn rate or time? Do you also track that when investing in companies?
I mean, we track burn rate a lot, right? Because we were talking before the panel got started here, like there's not a lot of investors in tools and services. And so if you're going to run a high burn company, you need to be a world-class fundraiser, or you're going to have financing risk on top of everything else that stands in your way of building a good company. So we at Broad Oak are looking for companies with prudent capital asks and fairly low burn rates. We'll absolutely do unprofitable companies. But we want companies that are trying to be capital efficient. Now, capital efficient is very different than being frugal, right? We want you to spend the money and generate more and more value with that. And there's a cash trough that you have to go through, and that's where the burn rates are. But if it's going to cost tens of millions of dollars to get somewhere, or you're running very expensive real estate and lots of people, and just expecting the money's going to keep coming, as many people on the call here today probably know, that money dries up in market cycles like now. And so we're seeing businesses that are not able to find funding all over the place, right? So we track burn rate very closely. I think something like TAM is more subjective. It's very hard to define, especially in emerging markets. So, some people, that's all they care about. And some people would say, if you've got a TAM, then I don't like it because it's too, established of a market. I would say, we're looking for markets that we think have high growth potential, but we're not so much, or at least I'm not looking at the dollar figure there. I'm looking more at things like publication rates, conference presentations, what the public companies that are the customers are doing and saying on earnings calls about that space. And it's less about, hey, it's a $40 billion market. Because if you put that on a slide and then I ask you to defend it, we end up at a very different number that, is somewhat subjective. So I would say, if you're going to build a market size, do it from the bottoms up. And think about who you can actually sell to, not just that the bioprocessing market is $100 billion, right? Like, who are you going to sell to, and what geographies, and what are they willing to pay, et cetera. But I'd say us personally, very interested in market size, but more on these like non-monetary figures to gauge how hot that market is.
I think
I can just say a word on TAM too. I mean, not all TAMs and tools are created equal. I mean, I think in order of preference, I'd rather have a better mousetrap for a red ocean market, a red ocean TAM that I can clearly bound. Cell sorting is a X million market because that's exactly how many sales are in that market. You have a better mousetrap and you've got early customers. That's great. That may not be the biggest TAM, right? TAM speaks to this upside over, a multi-year period, but that's probably the easiest investment case to buy into. The second easiest is in sort of a blue ocean market where you have a company that is wildly dominant, but that TAM might be very small, right? So your TAM might be 150 research institutions globally, but you're able to sell them $1 million machine with a huge level of recurring revenue afterwards. And you're totally dominant, but because you're totally dominant, you can invest to build that blue ocean application, because that is probably one of the most expensive things outside of drug development, is building a blue ocean market in tools. Oh my Lord. And then the last one, where you typically get the biggest TAMs, but is the least attractive, is building a blue ocean market where there are a lot of alternatives, none of which exactly addresses what you want. And so you have to build that. You have to build both the need and then convince people that you're the best. And while that might have the biggest TAM, that in many cases turns out to be the worst investment in tools, for better or worse.
Yeah, the highest burn rate companies I've worked with were trying to create a market that didn't exist, because you're constantly getting, going back to these pilots and things, right? You're constantly getting this feedback that people are interested, and I can't cut my burn rate because what if the big company signs and I need people to support it? And you psychologically convince yourself that this market is huge and it's imminent, and you just dig a deeper and deeper hole. So Alex is absolutely right on that.
I think the other thing is also that actually for startup founders, they read the press about this startup that raised 50 million, this startup raised 100 million, this startup raised 250 million. And so they think, oh, I need to raise like $250 million because that's what everybody else has been doing. What they don't quite appreciate is many of those other $250 million companies will have gone bankrupt because they raised too much money and they ended up making a company that might have been worth $20 million, not the 250 they raised and burnt. And so I think that there's a misunderstanding from the startup founding world to think that you must raise hundreds of millions of dollars, or at least many, many tens of millions of dollars. Whereas in fact, actually from the investor point of view, if you see somebody who actually can show you they're going to get to a sensible level of success and they're not going to need to spend very much money to get there, that's more compelling. Even if it isn't such an enormous TAM, it's a more focused TAM. But you can say, look, I can really control my destiny in this space with this modest amount of money. That feels more compelling than I'm going to burn $200 million and I'm definitely going to make a unicorn. It's like, well, there aren't that many unicorns, so you probably aren't going to make a unicorn. You're probably going to burn $250 million and make something worth tens of millions of dollars. So don't do that.
Yeah. I think just building on everybody's great comments. Oops, sorry, it's been a noise here. Just building on everybody's great comments. I think that it's just as important as understanding your market size as it is your exit strategy. And so, it's one thing to think that you're going to be a company that's lasting forever, but if you have venture capital on your books, they're going to be looking for an exit. How is your exit? Very unlikely in the tool space to be an IPO. It can happen, not unlikely. Probably one of the larger players is going to grab you. What is it that they need to see in terms of your multiples and your recurring revenue to be attractive to them from an acquisition standpoint? I want to know that. So you can write your TAM, especially if it's bottom up. I'm here for bottom up calculations, and you could give me numbers all day long. But if you can tell me you've spoken to the major market pull, again, to Austin's point earlier, major potential acquisition paths for you in the future, you have a pretty good understanding, both from legacy acquisitions and exits, as well as future looking, that you fit in their strategic area. You know what it is that they want to see from you. You have a path to getting to that level of revenue. You have the channel partners to make it happen. Then I'm like, oh, okay, now I feel that you've got the inklings of something real, as opposed to it just being another multi-billion-dollar thing. And building on what Mark just said as well, I think it's down to the investor community. The VCs as a whole have done a disservice to startups and founders across the globe because we have glamorized the size of the raise. Somehow that is an objective in and of itself. How much money are you raising? And then you're raising more. You never mentioned what valuation you got it at. It could have been a massive down round. And also, why are you raising that much capital in the first place? If you were raising that much debt finance, you don't necessarily publicize that to the world. So it should be fit for purpose, getting high value investors the right amount of capital you need to hit your value inflection points, rather than what is the quantum I have in this press release. But the VC world has created this toxic cycle. And in our research tools space, so many of the companies we invested in at StarCode, 28 companies in our portfolio, most of them in the tools and platform space, the number of investors who say, oh, wouldn't you much rather be developing a therapeutic asset? Oh, that's what I invest in. Oh, you're only raising 5 million, but my minimum check size is 5. Shouldn't you be raising like 20 or 30? Yeah, come back to me with a plan for that. We are just as bad as anybody. And there needs to be a reckoning in the VC space about how we communicate to companies who are trying to really build a solid business rather than just another headline.
Yeah, again, all very valuable lessons, and I hope it's helpful for the audience today when they're raising funding, because for many people, many companies that we are working with, I think their funding climate or the market situation, especially for research tools right now, is not so favorable. And so the next question I have is for companies that find it's very difficult to get some funding. Do you have recommendations on other funding routes or have a strategy for them to actually get funding? And one question from the audience is, what would be the ideal ratio of organic revenue growth versus investment funded growth?
100% organic would be great. But that's not necessarily realistic. Just some ideas. None of these are better than the other, just maybe things. I mean, I generally would have said the NIH. We'll see now, I guess. But non-dilutive funding mechanisms are good. If you have a product, it can be really interesting to do services first while you're developing it. So offer a service on the product that you ultimately wish to sell. Do that work, on a widget without a hood on it, because you're not finished building it, but you can start to demonstrate that value. And that becomes a way to better understand the needs of the customer and kind of refine the product that you want to make. You can bring in some revenue along the way before you actually go out to launch it. So that can be a more capital efficient way. A lot of the companies that have raised very little did services or project work early on to pay the bills. Angel investor syndicates can be a great way to get started. So those are a few easy ideas.
I think, Austin, you're right. I think that in my history as a CEO founder, then I raised modest amounts of money compared to what we ended up doing. But that's because we did run services. We did have revenue coming in from day one that covered some significant proportion of costs. And that meant we could go long. And then also we ended up having quite a lot of different grants, not from the NIH, but from European versions of those sorts of things. That made a massive difference to how much progress you would make. The downside, I mean, whether it's a downside or not is a slightly different point, but it takes longer. You can't just do it all in 3 years. It took probably 10 years to get to the same point that a startup might have got to in the meantime. But the key thing, which I think comes back to what Jason was saying from the very beginning, was the thesis that we had at the very beginning wasn't the right thesis. And we had 10 years to explore what the right thesis was. Whereas if you burn capital, you've got 3 years, you've got to somehow go through the same exploration process. You might not find the sweet spot before you run out of capital and run out of investor interest, basically. Whereas if you've got services and grants and various other things that keep you going for longer, you've got more shots on goal, simplistically, and more shots on goal leads to a higher chance of scoring some goals.
Yeah, and just to
Jason
echo
and
Austin,
Alex,
so sorry to jump in, but just to echo, Austin, we're primarily a European investor, and if you're a European tool startup, there are many sources of semi-government or regional VC funding that are available. These are not going to be, specialist tools investors. Don't count on them for deep insight into your markets, but they are sources of capital, and they in general they are available up to a certain amount. You will cap out once you start to raise kind of more than maybe 5 million euros. But that's a pretty unique aspect of the European ecosystem. And then of course, to Austin's point, I mean, there are grants not only from the NIH but private foundations as well in the US, which can be great sources of funding, DARPA, et cetera.
Yeah, I'm just going to give a quick shout out to corporate venture. Not that I necessarily recommend bringing it in too early in your cap table. And it's always ideal to have at least 2, if you can, CVCs, but beggars can't be choosers. But if you do have a corporate venture investor on your cap table who is aligned with your interests and a potential partner in the future, it can be beneficial. Not always, but it can be. So something that people should explore. Danaher and others, Biorad I met with recently, etc. There are plenty in the tool space, CVC operations who do want to come in early. Just make sure you let the right ones in and it's on good terms. But it's another source of investment.
I think that's right. I mean, I had GSK invested in the company I built originally, and they had a lot of helpful things they would do for us, but they didn't have very many special rights of any kind. So that was kind of good. But I've come across a couple of companies recently where, well, and it's fair to say in that GSK situation, all the people that made the original investment ended up not being at GSK anymore. So you have to basically imagine the scenario that when you're talking to the corporate, the individual you're talking to and the kind of the principle behind what you're agreeing doesn't really matter, because it has to survive by what's written down in the case that those people have moved their jobs or moved companies, and that the new people can read it and then believe and understand what it was, what's written. So I've come across a couple of situations recently in Boston where there are some companies invested with corporate venturing, and the corporate venturing organization had some special rights, but now the people have all moved and nobody at that corporate is willing to make a decision, while the company can't do anything because the corporate's not willing to make a decision. And it's like, so that's really then stuck between a rock and a hard place. So you have to imagine the scenario that the people aren't there anymore that you're dealing with, and it's not through any fault of anybody being deliberately difficult. It's just they've just gone and the principles have been forgotten. So, but I've done very well out of corporate venturing, and also had corporate venturing from a Japanese corporation as well. So, yeah, so I think it can work really well, but you have to just imagine the scenario those people aren't there anymore.
Yeah, I think that to build on that too, as another caution is market signals are important. If you have an investor on your cap table who doesn't do a partnership deal with you, who doesn't invest in your next round, at least for Rata, et cetera, all these things can send a signal to the rest of the market that can be perceived quite negatively, even if it's for the best of reasons. Maybe you're no longer a strategic fit. That happens, right? But people will still look and think, but if your current investor isn't backing you, something must be up. So also be careful and think about that, particularly with corporate VCs. If you have someone on your cap table and you're no longer in their strategic lane and they are no longer backing you, the next corporation or the next investor coming along might look at you a bit funny. So something else to keep in mind.
Yeah, thank you all. I just want to call out to the audience. If you have any question to the speaker today, please send in your question in the Q&A chat box. Yes, and I do have one last question for all of you. This is the question we ask all our speakers in every session. If you could give one advice to someone starting a company today regarding getting funding, what would be your advice?
I think that this is a hard job to sign up for. Life Science Tools has amongst the longest sort of company development pathways of any industry, sub-industry within healthcare, probably within any industry. I just wouldn't know. And therefore, if you look at some of the, just taking wealth as an example, like if you look at some of the richest founders, they've built companies where they've had to take no money or very little money. Look at Formulatrix.
Yeah.
I mean, look at some of these. I mean, look at most of, Protein Tech. These are companies that had to take barely any money. And meanwhile, some of the biggest successes were not successful for investors. Look at Protein Simple. Because of the dynamics of capital and the time that it takes to develop these companies into larger revenue generating and EBITDA generating companies. So I would just say, what is my advice? I would say just, in some cases, it doesn't make sense to take on more capital to force a growth rate, because it ends up bad for everyone. And in many cases, this is something to grow on a very small amount of capital over several years before you ever look for capital, if indeed you need it.
I guess I'm assuming the question probably applies most to someone raising their very first or maybe second, very early stage round of capital. I would say I'm going to cheat and give sort of two. One is just in this market, if you need money and it's presented to you, beggars can't be choosers. Take it. Don't try and over negotiate your way out of it. I did some data analysis recently, and sort of the supply demand in our market for dollars available versus dollars that are being sought is about 1 to 3, 3 to 1. So there's people asking for $3, €3, et cetera, 3 times as much money as is actually available. So if you're one of the lucky few that gets it presented to you and you need it, take it. Now, the second piece comes with that, which is when you take that money, you are signing up for a relationship and a promise to work on this with all your heart and might for a foreseeable future, make sure that's what you want to do, because investors, and it's hard to back out of those relationships if you take it from somebody that you shouldn't have. So just know that this is a commitment, and be devoted, be willing to build through market cycles and what it takes. So ultimately, if you need money, take it. If you are taking it, make sure you take it from somebody that you want to be in a contractual arrangement with.
I'll quickly add that it's come up before in today's panel. Relationships are so important with customers, with potential investors, with your existing investors, if you have any. You have to really develop those relationships, spend the time getting to know them. I think Mark even said earlier, go out for meals, get face-to-face time. Zoom is not good enough. I know we're in a virtual Teams panel today, but the more in-person interaction you can get with people, the better. And it's because those relationships will keep you front of mind. It will help you hone your product and your strategy, and it will make sure that you focus on quality of interaction rather than just quantity. I think a huge mistake I see, especially in the pre-seed companies we've been looking at over the past 6 years, they think it's a numbers game. Oh, I just have to pitch to X number of investors and one of them will hit. And I see people come to me with spreadsheets where they've burned bridges with 120, sometimes 130 different VCs. And I think, what have you done? They're like, oh, well, I just keep finding new people to pitch to, and eventually one of them will stick. That's not how this works, particularly in today's climate. They want to really believe in you, believe in the market, believe in the product that you hope you'll develop. And you get that by being very focused and building those relationships and leveraging your contacts to meet people with warm introductions and expand out naturally. Going to pitch events and things like that can be helpful. There's serendipity always, but I have always found that quality relationships are much more productive in fundraising and everything than quantity.
I think just actually one interesting point on that front is you think about, why are you three sitting in this meeting? Well, Jason, I mentioned a dinner and then subsequently have had coffee with a few times. Alex reached out to me once a bit randomly on LinkedIn, and then after that we've had coffee quite a lot of times. Austin, actually, I've met through your colleagues actually at Broad Oak, Austin, but we've invested in things together. So kind of like, it's those personal relationships that mean that, why did you guys come to this thing? I mean, it's probably because Mark asked you to. That was about all, really. The other point I'd like to say about the company side of things, though, is that I think I see startups that spend an awfully long time spending almost all of their emotional power selling to investors, and they totally don't sell to customers. And you think, well, surely you're just actually, if you're just selling to investors, you're just messing around. You're not actually running a business. The place where you have business is when customers are giving you money for something, a product or a service you have, and then you make gross profit out of that allows you to build a business going into the future. And actually, it's kind of a Y Combinator-esque kind of like almost like mantra around investor focus, about Series A, Series B, Series whatever the hell it happens to be, that ends up with people forgetting what you're supposed to be trying to do, which is build revenues. And I think that's the point which I think was useful about what you said, Austin, is that some of the best companies haven't had much, if any, investment other than potentially their own money or family money or something else to get themselves moving. All businesses need some sort of investment that they get at the beginning, but basically you should be selling to customers much more than you're selling to investors, even at the beginning.
Yeah, I would say on that point, maybe not an absolute, but directionally true, is if you find product market fit, the investors will find you, right? Generally, if you're out searching for money, it's because you're still trying to find it. To Mark's point, and I agree with him, if it may take longer, but it's much more optionality with less people looking over your back to try and find that product market fit. And again, when you do, the investors will find you. Again, the biggest successes I've had were companies that found product market fit in high growth markets and had to raise money because they were growing so fast, and investors flock to you then. But when you are trying to convince somebody that you found product market fit, and that investor, by virtue of being involved in tens or more companies, has actually seen it, then there's a lot of skepticism of whether you've truly found it. And that's where all these questions come from. So if you're trying to convince somebody you found product market fit, I would default to maybe you haven't. and to try and do what Mark is implying here, which is get out and talk to the customers more and try and figure out where that swim lane for your business is to generate more revenue and drive more interest.
Yeah, no, and also the point which Jason was making about investors, if you've spoken to 130 investors and they've all said no, and you keep telling the same story, there might be something wrong with your story. So in the same vein, if you're talking to customers and all saying no, that doesn't mean you just keep going talking the same. So you should evolve your story and change your thinking and evolve it gradually over time as you're speaking to people.
Yeah, it could also mean you're talking to the wrong people.
Yeah.
I've seen that mistake happen too often. Customer, partner, investor, you name it. You might have the right solution, but you're talking to the wrong audience. And so that's the other thing. It's really being objective. And if it's hard to be objective, we're subjective by nature in humans. So if you need somebody who's going to be a voice of reason, find a good objective friend who will give you the hard truths. And if they think your baby's ugly, then they'll tell you your baby's ugly. Same thing goes for your business plan and your technology. Find people who will give you that honest feedback early, rather than just looking for confirmation that you're brilliant.
Yeah. So we have 5 minutes. Actually, now I think it's 4, and we have some question. I'll just ask one of the audience to ask the question. Alker, are you there? I'll allow you to speak and also open your camera.
Yes, hi, I'm here. Thank you. I'll ask my question very quickly. So basically, I was pitching to VC. I'm a pre-seed founder, and I proposed a business model in which our calculation showed roughly 5x return on their initial investment, and the response was quite shocking to me. They said it's not good enough for them. So like, I don't want to forge my numbers to match to their expectations. So how should I respond to that? Thank you.
Jason, I don't think 5x on a pre-seed is going to be enough. You need to see, and I posted in chat, like you need to pitch a 20x on a pre-seed, if not more, if it works, because 90, sorry, Jason, you're the expert here. Yeah.
No, I was just going to say, Alex, it depends on what your growth trajectory is and what you're trying to do. There are investors, they're either impact investors or investors who are angels who might give you enough money. It depends how much you're raising. A 5x to some people would be a wonderful outcome. Now, for my fund, I would have been raked over the coals by my investment committee, but there are investors out there where a healthy 5x business, or if that's just the first product stream, maybe you have other products that you have in mind that could be generating and then adding value. There are ways to nuance it. It's hard to say without seeing your pitch, but also make sure, so that number at a high level, 5x, oh, I'm out. I think find the investor who can lean in and see if they can get that higher, that can really understand what you're trying to do.
I think the key thing about it's about risk reward balance, right? So if it's not very risky, if it seems pretty guaranteed it's going to work, then 5x seems great. But if it feels incredibly risky, 5x doesn't seem like it's enough to take the risk.
Yeah, I was going to say the why here matters, right? So Mark's point is one, which is valid. The second is if I've got a pre-seed fund, then my portfolio construction is thinking about how many companies I need, how many are going to be successful, how many are going to fail, taking those sort of expected values and probabilities and backing into a fund level return. A 5x on my successful company, if you hit that, is not going to pay for all the losses that statistically are going to happen. So pre-seed fund needs outside success and returns from its bigger companies to make up for the ones that it loses. So if you are going to be a winner at 5x, you really don't do much accretive to that portfolio. But if, to Mark's point, your downside risk is much lower, you could fit into a fund structure that has a different risk reward underwriting across that portfolio.
But this is also why you don't necessarily have a venture backable business, and that's fine. I've seen plenty of amazing companies that are not venture backable, but they're still strong companies, raised from angel, raised non-dilutive capital, get some early revenues in, and really grow organically and have wonderful exits without having to raise much capital up front at all. Don't assume that you just have to come up with a story to get pre-seed investment from a VC fund because that's the only path forward. It may be you've got a perfectly viable business idea and you don't need VC capital and you'll never be a good fit, so you find alternative funding.
I mean, I'm just looking at some of the people who are attending here at the moment, and I can see one particular person. I'm not going to highlight unless they specifically want to, but it's somebody who hasn't had money from outside but has done a lot of suffering instead. So personal suffering, and that is another mark of a successful company is where the founders actually really have just had to go through a very, very difficult periods of time to get to the point where you basically have a company that's viable and successful. And you know, maybe if you get investment, you don't get suffering necessarily because you have money to pay your salary, but instead you end up, potentially speaking, cashing out and then having it just be dead completely. Whereas if you're willing to accept suffering for a long period of time and really just keep going at it without getting very much money to survive, then you can actually make a really, really powerful business because you'll have a lot of time to do it. But it depends on people's personal circumstances as to whether you can actually do that. So yeah.
I want to elaborate on Jason's point real quick because it's this comes back to a theme from earlier that we've done some a bit of a disservice from the venture capital world, which is to say that like the history of venture capital was, the whole industry kind of got started to fund high capex businesses with low probabilities of success and huge outcomes if they work, right? Which is not a modern software business. It's not even a lot of tools or services businesses. So, in my view, I see kind of three reasons you would take venture capital. It's that type of business model where you cannot build it without somebody giving you a lot of money, and the bank's not going to do it because it's a huge, crazy idea and really risky. So that's one. The second would be if you've truly found high growth product market fit in an early stage business and you just want to pour fuel on the fire. Or third, if it's like a winner take all market where you need money as a weapon to get out in front of everybody else. I would say 1 out of 100 businesses fit that mold. And then maybe 10 are like a car wash and can go get a bank loan. But that other 89 businesses, like where do they get capital from? We've ended up funding them with VC, and we start to, as investors, like squint and look and say, well, maybe that's product market fit, or I raised this fund, I got to put it somewhere. And that doesn't do anything for the entrepreneur. So I would say, think long and hard about, do you fit in this venture capital profile? And is that the journey you want to sign up for? If not, really think about some of these other ways to fund your businesses that are much more aligned with the risk and reward you're taking on.
Thank you so much, Austin. And I think, that brings us to the end of the session today. I hope that all of you have enjoyed the discussion because I enjoyed very much coming here, thinking about the numbers, but then also learn valuable lessons about building relationship and also understanding the circumstances. Again, huge thank you to all the speakers for your time, your stories, and your perspective. Yes. For people who are registered to our newsletter, we'll send you the update about the next episode. And so I spent some last minute for each of you to say goodbye to the audience.
Thanks, everyone. Thanks, Mark.
Thanks,
and Ann,
everyone.
for setting this up. It's a real
Yeah,
pleasure.
Thanks for having me. Been a lot of fun.
It's been fantastic. Great meeting you guys. Thanks, Mark. Thanks, Anna. Thanks, everyone.
Okay, guys. Thank you very much.
Take care.
Thank you.